Silver investors are about to discover something the financial world has spent years ignoring. Not next year, not someday, soon. And when this surprise becomes obvious to everyone, the biggest gains may already be gone. The question isn't whether silver will shock the market. The question is whether you'll be positioned before it does. There is a peculiar habit in modern finance. We tend to assume that whatever has happened recently will continue indefinitely. Rising markets become permanent, falling markets become permanent, stability becomes permanent. Yet history, with its relentless refusal to cooperate with human assumptions, teaches the opposite lesson. That lesson may be especially relevant to silver investors today. At the time of this recording, silver remains one of the most misunderstood assets in the financial world. Depending on the day in the market, silver has recently traded in the neighborhood of $60, $70 to $75 per ounce after experiencing extraordinary volatility earlier this year. Some data providers recorded highs above $100 per ounce during the historic surge of early 2026 before a dramatic correction followed. The result has been confusion, skepticism, and a growing sense among ordinary investors that silver is simply too volatile to understand. That reaction is understandable. It is also precisely why this opportunity may exist. The great irony of investing is that the crowd becomes comfortable with an asset only after its most significant move has already occurred. People rarely become enthusiastic at the beginning of a trend, they become enthusiastic near the end of one. They rarely ignore opportunities when they are obvious. They ignore them when they are inconvenient, uncertain, and widely misunderstood. Silver today possesses all three characteristics. For years, investors have been conditioned to think about wealth through the lens of digital numbers on screens, retirement accounts, index funds, bond portfolios, technology stocks. Financial assets dominate the conversation because financial assets have dominated performance, but every generation eventually discovers a truth that previous generations learned the hard way. Paper promises and tangible assets do not behave the same way during periods of monetary stress. Throughout history, civilizations have repeatedly experimented with debt, currency expansion, and financial engineering. Some experiments lasted decades, others lasted centuries, none lasted forever. The reason is simple. Reality eventually demands reconciliation. A government can create currency, a central bank can create liquidity, financial institutions can create leverage, but none of them can create silver. Silver must be discovered, silver must be mined, silver must be refined, silver must be transported. And because of that reality, silver belongs to a category of assets that the modern financial system often struggles to properly value until scarcity becomes impossible to ignore. That scarcity story is beginning to emerge again. Consider the broader economic environment. Governments around the world continue carrying debt burdens that would have been considered extraordinary only a generation ago. Interest expenses consume larger portions of public budgets. Currency purchasing power continues facing pressure. Investors increasingly search for assets capable of maintaining value in a world where financial obligations expand faster than productive output. Historically, precious metals have occupied a unique position during such periods, not because they are magical, not because they are perfect, but because they are finite. Silver, however, differs from gold in one critical respect. Gold is primarily accumulated, silver is consumed. Every smartphone, solar panel, semiconductor, medical device, electrical connector, and growing category of advanced technology requires silver because silver remains the most conductive metal known to industry. That fact changes everything. When investors buy gold, they compete primarily with other investors. When investors buy silver, they compete with investors. Manufacturers, technology companies, energy producers, and increasingly the infrastructure builders of the artificial intelligence revolution, most people have not fully absorbed the implications of that reality. The headlines focus on artificial intelligence companies, the headlines focus on semiconductor manufacturers, the headlines focus on data centers. Very few headlines focus on the raw materials required to build those systems. Yet every technological revolution eventually encounters physical constraints. The digital world still requires physical resources. Data centers require hardware. Hardware requires components. Components require metals. And silver occupies a uniquely important role in that chain. This creates an unusual situation. On one side stands investment demand. On the other stands industrial demand. Both are moving toward the same finite supply. History suggests that when multiple sources of demand converge upon limited supply, price eventually becomes the balancing mechanism. The timing is always uncertain, the direction is not. That is why silver investors may be approaching a surprise that extends beyond price alone. The surprise is psychological. For years, silver holders have been conditioned to expect frustration. Periods of excitement have been followed by corrections. Periods of optimism have been followed by disappointment. The market has trained participants to doubt every rally. But markets often create their largest moves precisely when confidence is weakest. The investor who studies history discovers a recurring pattern. First comes neglect, then skepticism, then gradual recognition, then sudden enthusiasm, finally euphoria. Most fortunes are not made during euphoria, they are made during neglect and skepticism. That observation brings us to the central question: what if the conditions currently developing are not temporary? What if industrial demand continues expanding? What if monetary concerns continue intensifying? What if physical supply remains constrained? What if multiple trends that previously operated independently begin reinforcing one another simultaneously? If those conditions persist, silver's future may look very different from its recent past, and that possibility is precisely what many investors remain unprepared to consider. Before we continue, take a moment to subscribe if you're interested in understanding economic shifts before they become front-page news. The biggest opportunities rarely arrive with widespread agreement. They arrive disguised as uncertainty, and silver may be offering one of the most important examples of that principle today. Because the real surprise facing silver investors is not simply that silver could rise, it is that the forces driving it may be far larger, far more durable, and far more structural than most people currently realize. And once those forces become visible to the broader public, the conversation surrounding silver may change faster than anyone expects. There's a difference between owning something and owning a claim on something. That distinction sounds academic until the day it becomes important. History suggests that when financial systems become stressed, the difference between the two can become the difference between confidence and panic. Most investors assume silver is silver. If the price goes up, their investment goes up. If the price goes down, their investment goes down. Simple, except it isn't, because there are really two silver markets operating at the same time. One is the physical market, the other is the paper market. The physical market consists of actual silver bars, coins, industrial inventories, bullion vaults, and refined metal that can be delivered, stored, used, and consumed. The paper market consists of futures contracts, options, exchange-traded products, derivatives, and various financial instruments designed to provide exposure to silver prices. Under normal circumstances, these two markets move together. Most of the time, investors never notice the distinction, but history repeatedly demonstrates that during periods of stress, normal circumstances disappear, and it is precisely during those periods that surprises occur. Think about the broader structure of modern finance. The system functions because most participants do not demand immediate delivery of everything they technically own. Banks operate this way, bond markets operate this way, commodity markets operate this way. The assumption is always the same. Most people will settle financially rather than physically. Most people will accept exposure rather than delivery. Most people will remain satisfied as long as the system continues functioning smoothly. For decades, that assumption largely held true within silver markets. Institutional participants traded contracts, funds traded exposure, speculators traded volatility. Very few participants actually wanted truckloads of silver delivered to their warehouses. The contracts were enough, the exposure was enough, the system worked because everyone accepted the rules. But what happens when attitudes change? What happens when investors become less interested in exposure and more interested in ownership? That question matters because physical silver is not an unlimited resource. According to industry estimates, global silver markets have experienced recurring supply deficits in recent years, with industrial demand increasingly competing for available production. Meanwhile, mining output growth has struggled to keep pace with long-term consumption trends. That dynamic introduces a fascinating possibility. The growing number of participants could begin seeking physical metal at precisely the moment industrial users need more of it. When that occurs, something remarkable can happen. Premiums begin rising, availability begins tightening, delivery timelines begin expanding. The physical market begins sending signals that differ from the paper market. Most people ignore those signals at first. The financial media certainly does, because premiums on silver coins are not as exciting as stock market headlines. Inventory shortages at bullion dealers do not receive the same attention as technology earnings reports, and yet those seemingly minor developments can reveal important information about underlying conditions. History offers a useful lesson here. During previous periods of financial uncertainty, physical precious metals often experienced surges in demand that overwhelmed normal distribution channels. Dealers reported shortages, waiting periods increased, premiums expanded dramatically. And throughout much of that process, traditional financial commentary remained focused on paper prices. The result was a strange disconnect. The physical market was signaling one reality, the paper market was signaling another. Most investors only noticed after the gap became impossible to ignore. That possibility deserves attention today, not because catastrophe is guaranteed, not because collapse is inevitable, but because market structure matters. An understanding market structure often provides an advantage long before headlines catch up. Now consider another factor. Governments around the world are increasingly focused on strategic resources, critical minerals, industrial metals, supply chains, national security inventories, energy transition materials. Silver touches all of those categories. Its importance extends far beyond jewelry and investment demand. Modern civilization increasingly depends upon technologies that require silver. The more technologically advanced society becomes, the more essential certain materials become. Silver is one of them. This creates a situation that few investors fully appreciate. Every ounce purchased by a solar manufacturer is an ounce unavailable elsewhere. Every ounce consumed by electronics production leaves the available supply pool. Every ounce committed to industrial use competes with investment demand. Unlike gold, much of silver's industrial consumption is not easily recoverable in the short term. Once incorporated into millions of devices, recovery becomes difficult, expensive, and often uneconomical. That means silver faces a challenge few assets encounter. It is simultaneously a monetary metal and an industrial metal, the store of value and a consumed resource, a financial asset and a strategic commodity. Few investments occupy that unique intersection, and that intersection may become increasingly important over the coming decade. Now imagine an ordinary investor named Michael. He follows financial news, he watches market updates, he pays attention to inflation. He has heard arguments for silver before, he has also heard arguments against it, so he waits and waits and waits because waiting feels safe. Action creates responsibility. Inaction creates comfort. Then one day silver moves sharply higher, not gradually, not politely, rapidly. Financial television begins discussing it. Analysts appear on panels explaining why it happened. Articles are published. Predictions are made. Suddenly everyone notices. But by then something important has changed. The easy opportunity is already passed. History teaches that markets rarely send invitations before major moves. They send clues. The invitation arrives afterward. That is why successful investors often appear lucky. In reality, they simply acted while uncertainty remained. They understood the evidence before consensus formed. They recognized the significance of developments others dismissed. Most importantly, they understood that waiting for certainty often means paying a higher price later. This brings us back to the surprise facing silver investors. The surprise is not merely higher prices. The surprise is how quickly public perception can change. An ignored asset can become a celebrated asset almost overnight. A neglected market can become a crowded market within months. A forgotten opportunity can become a headline story faster than most people imagine. And when that shift occurs, those already positioned experience a very different emotional journey than those watching from the sidelines. Before we continue, if you're finding value in this discussion, subscribe and join our community. The goal isn't to predict every market move. The goal is to understand major trends before they become obvious, because by the time everyone agrees, the biggest rewards are often already behind us, and what we're about to discuss next may be the most important trend of all, because even the paper versus physical story is only part of the picture. The truly extraordinary development is happening inside the industrial economy itself. Artificial intelligence, advanced computing, energy infrastructure, defense technology, semiconductor manufacturing. These industries are creating a level of silver demand unlike anything previous generations experienced. And when you combine that industrial reality with monetary demand and constrained supply, the result may be the biggest surprise silver investors have seen in decades. The numbers behind that story are astonishing, and once you see them, you may never look at silver the same way again. The most dangerous phrase in investing is not "this time is different." The most dangerous phrase is "nothing is happening." Because history shows that the largest financial shifts often begin during periods when most people believe nothing is happening at all. That may be exactly where silver stands today. The headlines are focused elsewhere. Artificial intelligence dominates financial television. Technology stocks capture investor attention. Political debates consume public discussion. Interest rates, elections, deficits, and international tensions compete for every available headline. Meanwhile, one of the most strategically important metals on Earth continues to sit quietly beneath the surface of public awareness. And that silence may be the biggest clue of all. Consider what is happening simultaneously across the global economy. The world is attempting the largest energy transformation in modern history. Governments are funding renewable energy projects at unprecedented levels. Artificial intelligence companies are spending hundreds of billions of dollars building computing infrastructure. Defense budgets are rising across major economies. Semiconductor manufacturing capacity is expanding. Electrical grid modernization projects are accelerating. Every one of these trends appears different on the surface, but beneath the surface they share a common requirement: physical materials, real resources, finite commodities. And among those commodities, silver occupies a uniquely important position. Silver remains the most electrically conductive metal known to modern industry. That fact is not an opinion, it is physics. Solar panels require it. Advanced electronics require it, high-performance computing systems require it, medical technologies require it, defense systems require it, artificial intelligence infrastructure requires it. The digital revolution is often described as if it exists entirely in cyberspace, but cyberspace still requires physical hardware, and physical hardware requires silver. That reality creates a remarkable paradox. The more digital the world becomes, the more important certain physical resources become. Most investors focus on the software, few focus on the metals, yet history suggests that infrastructure booms often create extraordinary opportunities for the suppliers of essential inputs. Railroads created fortunes for steel producers, automobiles created fortunes for oil companies, electrification created fortunes for copper producers. The question investors must ask themselves today is simple: what resource sits at the center of the next great infrastructure expansion? An increasingly persuasive argument can be made for silver. Now imagine the next 5 years, not next week, not next month, 5 years. Data centers continue multiplying, energy infrastructure continues expanding, artificial intelligence applications become embedded into every major industry, governments continue competing for technological leadership, manufacturers continue securing critical resources. What happens if silver demand rises steadily throughout that period? What happens if supply struggles to keep pace? What happens if investors simultaneously begin viewing silver as a monetary asset during a period of continued currency uncertainty? At some point, the mathematics become difficult to ignore, and markets eventually respond to mathematics. Not immediately, not predictably, but eventually. This is where many investors make a critical mistake. They assume opportunities announce themselves clearly. They assume major trends arrive with flashing lights and official confirmation. In reality, opportunities often appear uncomfortable. They appear uncertain. They appear controversial. That is precisely why they remain opportunities. Once everyone agrees, the opportunity largely disappears. The crowd tends to arrive after the evidence becomes obvious. The most successful investors often arrive while the evidence is merely compelling. There is an important distinction. Think back to previous market cycles. Very few people wanted technology stocks in the depths of the early 2000s collapse. Very few people wanted real estate in 2010. Very few people wanted gold before its major advances. Very few people wanted energy stocks before energy shortages emerged. The pattern repeats because human nature repeats. People become interested after prices rise. Professionals become interested before prices rise. That difference creates wealth, and it may explain why some investors are paying increasing attention to silver despite the skepticism that still surrounds it. The objective is not to predict exact prices. Anyone claiming certainty about future market prices is offering confidence that reality rarely justifies. The objective is to understand probabilities, to understand supply, to understand demand, to understand incentives, to understand market structure. And when you examine those factors objectively, silver presents a fascinating case. Growing industrial demand, persistent monetary concerns, finite supply, strategic importance, limited public participation, those conditions do not guarantee extraordinary outcomes, but they certainly deserve serious consideration. Now let me speak directly to the silver investors watching this video. Many of you have been patient, perhaps very patient. You have endured volatility. You have endured skepticism. You have listened to commentators dismiss silver repeatedly. You have watched periods of excitement fade into corrections. You have experienced the emotional exhaustion that accompanies any long-term investment thesis. And that experience may actually be creating the biggest risk, because frustration often causes investors to abandon positions shortly before their thesis begins unfolding. History is filled with examples. People sold technology stocks before technology booms. People sold gold before precious metal rallies. People sold real estate before housing recoveries, not because they were wrong, because they became tired. Markets understand human psychology better than most investors understand themselves. The greatest tests are often patience tests, not intelligence tests, and silver has been administering patience tests for decades. The possibility that matters now is whether those years of frustration were preparation rather than conclusion, whether the forces quietly building beneath the market are finally approaching a point where they become visible, whether the surprise awaiting silver investors is not disappointment but recognition. Recognition by institutions, recognition by industry, recognition by governments, recognition by the broader investing public, because when recognition arrives, it often arrives quickly, and markets rarely wait for everyone to get comfortable. Before we conclude, I want to hear from you. Do you believe silver's biggest move is still ahead? Or do you think the market is overestimating the long-term opportunity? Leave your thoughts in the comments below. I read them carefully, and some of the most valuable discussions happen between viewers who bring different perspectives to the table. If you found this analysis valuable, subscribe and turn on notifications. The financial world is changing faster than most people realize, and our goal is to understand those changes before they become obvious to everyone else, because the investors who succeed are rarely the fastest, they are rarely the loudest, they are rarely the most emotional, they are the most prepared, and preparedness begins with understanding. Silver investors may indeed be in for a huge surprise, not because surprises emerge from nowhere, but because most people ignore the evidence until the evidence becomes impossible to ignore. The signs are there, the trends are visible. The question is whether you are paying attention before the crowd arrives. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk.